This is Accessing the Pipeline, a podcast for Black professionals in private equity and finance brought to you by McGuireWoods. Join host Rubin Pusha III as he welcomes special guests offering insights into accessing capital, developing and expanding relationships, opportunities, and driving growth for Black-owned businesses. Tune in to access the possibilities.
Welcome to Accessing the Pipeline. My name's Rubin Pusha III. I'm a partner at McGuireWoods and your host of Accessing the Pipeline. Please join me in welcoming Austin Smoak, who is the founder of Grove Oaks Capital. Austin, thanks so much for joining me on today's episode of Accessing the Pipeline. I think we're going to call today's episode Chasing the Elusive First Deal, since we're going to spend the majority of our time talking about your experience getting that first deal done. So, man, thank you again for joining us and welcome.
Definitely. Thanks for having me.
We'll jump right in. Could you tell us just a little bit about your private equity and finance background?
Yeah, definitely.
How we ended up here.
Definitely. So I'll give you a scope of who Austin is, and then we can dive into, formative experience and things of that nature. So originally from Atlanta, went to school in New York, went to St. John's University, got a BA in economics in 2017. After finishing that up, joined Goldman Sachs in the real estate private equity division. Stayed there from 2018 to 21. Decided to leave there towards the end of 21 to do a self-funded search. And that's what brings us to Grove Oaks Capital, which is started off as a search fund, as we had spoken about previously, Rubin, but which is now I would say, full-fledged lower middle market private equity investment vehicle.
Nice. And I know we talked about this a little bit before, but what was happening, in the marketplace or with you personally, professionally, that made you pivot from the search fund to more of an independent sponsor model?
Yeah, definitely. I'd say, I was never a traditional search guy, which those are more so implanted CEOs who vest in equity. I felt I'd be better as a deal maker. As an independent sponsor, you're more so structuring a management team and putting that into place. And those who operate a traditional search fund just go into the operator seat and typically are a CEO. So when I was looking at assets specifically, when it came to the one that we acquired, and it's a construction vertical, it's a roofing company, me with a banking background, and I didn't see myself as being the most appropriate CEO to kind of push it forward. So looking at, management structure, post-acquisition, I put a COO into place technically, and, I sit as the face of ownership.
Nice. And you give us just a little bit of background about Grove Oaks, but could you do a little bit of a deeper dive and, tell us, sort of what industries you're focused on, what's high level your investment strategy, check size, EBITDA, revenue, all the good stuff?
Definitely. So EBITDA threshold of anywhere from 1 to 4 million in EBITDA. I would say right now the strategic focus is home services within the Southeast, primarily Georgia and Florida. The platform that we acquired roughly 6 months ago, it's in the roofing space, as mentioned. Looking to scale that through roll up. So looking to get somewhere in the 7 to 10 million in EBITDA range within the next 18 to 24 months. And that's my primary focus, here in the next year or two.
I guess ballpark, how many add-on transactions are you forecasting to do to get you to that number?
I would say 3 to 4. Right now I have 2 under LOI. So if those go pretty well, it's more so looking at within Florida, a geographic focus of taking over an asset in the Southeast of Florida, the Southwest, we're central right now, and also Northern Florida, whether that be, Jacksonville or the Panhandle.
Awesome. Well, look, good getting a little bit of background about you and Grove Oaks Capital and the company you acquired. But I wanted to spend the bulk of today's episode talking about getting that first deal closed. I know for a lot of independent sponsors, and even for a lot of search funds, I mean, guys are, 12 or people are 12, 18 months, sometimes 24 months into this thing where they've had a deal or two under LOI or almost got them under LOI, couldn't get it done. So no small feat that you were able to get that first deal done. If you wouldn't mind giving us just a little bit of context on how long it took you sort of from an inception to wires going across to get that first deal done.
Definitely. So I formally launched the search in October of 21, but I would say I've been looking passively for a year prior to that. So it built out the Rolodex of brokers, lenders, equity investors. It communicated with the ecosystem for a while, prior to formally launching. After formally launching, I acquired a small network of franchises at the top of 22, which are more so, passive, personal balance sheet assets. Went back out to the market looking for a larger deal to do. After kind of understanding working with the franchisor, how much red tape is around, getting multi-unit opportunities within that. So went back out with the strategic focus around home services. Got a deal under LOI in May of 21. The diligence and closing process was arduous. That took roughly 7 months after getting it under LOI, and we finally closed in November of 21.
And when you were in the LOI phase, I mean, we tend to see, sponsors a lot of times kind of agree to things in the LOI phase that lenders, capital providers don't love. And then you end up trying to retrade on some of those things once you identify either your last resort capital provider or the capital provider that you really want to hit your wagon to. And so what were some of the, I guess at what point did you get your capital provider involved in the process, and were they involved at all in the LOI process?
Yeah, definitely. So there's a lender within the search fund ecosystem who's, I would say, top notch. They're the primary one most of the elite search funds go through in a deal that's, enterprise value anywhere from 5 to 15 million. So I built a relationship with them, over the course of a year plus, and I was sending them deals. And a lot of times they say, hey, no, this is not going to work at all. So I figured out, what type of deal was financeable from their standpoint. And also I worked with a syndicate for my equity. So finding what was attractive to that syndicate as well. And I found an asset that fit into that mold. So can I answer your question? It was pinpointing targets that were financeable.
Yeah. So they were involved before you even got to the LOI phase.
I probably had 10 deals under LOI prior to the one that I closed. And everyone that I brought, not everyone, but most that I brought across were no's. And they were for, specific reasons. So that taught me what I can actually get across the finish line.
Nice. That's good perspective for other independent sponsors out in the space. A lot of times I encounter independent sponsors like, oh, I got a deal under LOI. Who are some capital providers you recommend I reach out to, or who are some people that could do a Q of E for me, or whatever it is. And which is, it's great as a law firm to be able to be that resource for folks in the space, but also a good teachable moment to early and often be building those relationships and running things by them, so that as you find deals, whether it's going to work for them or not, because they're side by side with you in the process. So that's super helpful. Let's talk a little bit about, sort of what were your core principles in looking for your first deal? I mean, I know your capital provider and your syndicate had some say and were helping you sort of evolve your position on things. But at the heart of it, what were you really say would be like your table stakes?
So when I started the search, I was generally, industry agnostic. Anything, with operating profit or EBITDA above $1 million, I would take a look at. So it was pretty much anything across the gamut within the certain markets. Georgia, Florida. Was also taking a look in Texas, Chicagoland, as well as Southern California. So within those markets, I was taking a look at anything that fit within that EBITDA threshold. As I progressed and figured out which verticals were more attractive to both sides of capital, equity, and debt, I started to target that more. It's easier to throw things out the window, and it was easier to buckle down on certain assets. So that was generally the thesis and how I came about it.
What are some of those verticals that you are seeing in the marketplace as attractive for debt and equity providers for independent sponsors?
Yeah, well, it's different now than what it was previously. I felt like capital was a lot more lenient, maybe 6 to 12 months ago than what we're seeing in the environment currently. But when I was searching and on the hunt, home services was quite attractive, whether that be HVAC, plumbing, your tree services, roofing companies, et cetera. You're seeing a lot of private equity interests, lower and middle market firms coming in and, taking a hold of those companies. And there's a lot of multiple arbitrage down market that we're seeing or have seen.
And what's driving that? I mean, what are the real opportunities with respect to those companies? Is it digitization? Is it building out a stronger back office? What do you think
It's
is?
it's it's part of the latter. So if you look at it from a roll up thesis or my thesis, it's at the whole co level, being able to structure HR, certain processes at a unified level for 4 to 5 entities. It's creating a higher margin profile, and also taking some of the unique intricacies about from the first acquisition and putting those in place at some others that we're seeing in the market. And it's a highly fragmented market. It's creating a higher margin profile. So for me specifically, that's what I saw.
Nice. And I think the other big piece for independent sponsors and doing these deals is thinking through what they want their economics to look like. And I'm sure that, on one end, you've got a number of where you think so you're a couple of tranches of economics ought to look like. And then you've got your debt and your equity, and they may have a different viewpoint on what those look like. So could you just talk a little bit about, and this is more educational for our audience, right? Like where are the buckets of earnings that make up the economics of a sponsor? And then what are some of the negotiation pain points and trying to land on something that works for everybody?
Yeah, I would say the search fund ecosystem is split into two. So in the self-funded search ecosystem, there's a typical rule of thumb. You're giving away anywhere from 20 to 50 points in a deal to your equity base, depending upon what type of lending facility you're going to use. On the traditional search ecosystem, you're receiving a vesting package of anywhere from 20 to 25% within a company, and that vests over anywhere from 3 to 5 years. And that's similar to what you see in an independent sponsor model as well. The way I structured my deal was the self-funded search route. So generally, I had that thesis in mind, and that's what's been prevalent in the ecosystem for the last 3 to 5 years.
Got it. In terms of like that structure, did you find there to be some sort of sticking points where you think your capital provider was more interested in pushing one way or the other on the number?
Yeah. Lenders always want you to put more equity in the deal, and equity providers always want a larger chunk of equity. So it's always a negotiation. Good thing at that time when I was raising, the market was a lot more open than what it is right now. So you have more options, you have more leverage. Today we're seeing something totally different.
Right. No, yeah, definitely. I mean, debt is more expensive, obviously. And I think, others are a bit skittish.
That's right.
Right. They're in the kind of wait and see mode and kicking the can down the road a little bit more than they probably were when you were teeing your deal
That's
up.
right.
And I think it's something that, we're going to deal with for a little bit. And hopefully, by the time we get ready to roll out of the second quarter, people are ready to do some deals, and we see an uptick in activity.
So.
Some of that will probably include sellers taking less on the multiple front than maybe they would have 12 months ago. But there's some creative ways, I think, in the deal space to kind of make up those gaps. Maybe not completely, but between seller notes and earnouts, there's things we can do to get the deal activity flowing again. Coming out of this first deal experience, what would you say were, sort of your big teachable moments? I mean, this kind of covers the gambit, right? I mean, it could be with dealing with legal counsel, thinking about transition services as the sellers, getting out of, cashing out, and you're taking over the business or supervising to take over a business, diligence, whatever it might be. What are maybe one or two big teachable moments that you had through this process?
Well, I would say post acquisition, it's be humble. You don't know what you don't know. Lean heavily upon previous ownership, within that transition period, and try and squeeze as much as possible out of them, whether it's 3 months, a year, 2 years. Just try and really latch on and understand how they think about the business, and then you're always going to have your thesis going in of how I can make operations more efficient, or how we can spend less on materials, whatever it may be. But listen first, I'd say. That's post acquisition. Prior to acquisition, I was working with a family office who was going to be my sole equity check. They said no like 2.5 weeks prior to closing the deal. So I had to go back out to the market and raise from a myriad of LPs within a week. So these are all people that showed interest throughout that period, but it was, that was also a teachable moment. Keep all options open, prior to closing. Until you're across the finish line, you're not there. So
Yeah, no, that's an interesting wrinkle. 2 weeks prior to closing,
yeah,
man.
2.5 weeks prior to it was frustrating to say the least.
What was the process like going, sort of going back to the well, trying to get folks to open up a checkbook who had at some point probably realized you were moving forward without them?
Yeah, they did, but they didn't. It's funny. So prior to them saying, they weren't going to go forward with the deal, the family office, it was literally, I had put on my calendar the next day, like I was going to let the myriad of LPs that I've been speaking to previously, who were going to write, much smaller checks, let them know I was moving forward with the family office. So I kept both baskets open, so to say. But the communication with the smaller LP base, it was drawn out, for 3 months, So in saying that, there was, roughly 10 to 15% that had said yes, 3 months prior, said they couldn't do it anymore. So there was a gap, like a week before the deal closed, to be honest. So it was, it was a process, and it was a great teachable moment.
One of the things that I think, we see from Black emerging managers, Black-led search funds, Black independent sponsors, is a lot of times they just don't have the same Rolodex, right?
Yeah.
That some of our counterparts have in the space. What are some of the things that you did in order to build that Rolodex, as you were thinking 12 months down the line, hey, I'm gonna eventually find a target, and I know that I'm gonna pay for it in part with equity, and debt. How do you build sort of the relationships that are necessary to be able to do what you did and pivot, 2 weeks out, if you need to?
Yeah, I would say, prior to me even launching GrowOaks Capital, I was building a relationship with equity investors. That's mostly within the search fund ecosystem. So it wasn't, your typical capital providers in the independent sponsor ecosystem per se, but that was through conferences, networking with, ex-Goldman people who had, launched a search themselves, actually listening to a lot of podcasts, and then reaching out to those people post podcasts. How did you do this? We'd love to speak to you. And 1 leads to 2, 2 leads to 4, 4 leads to 8. It's that type of thing. And also to say, I did use a capital raising shop or syndicate. So, having that partner greatly helped. They sourced, I would say 60, maybe 70% of the capital needed from an equity perspective. And, my connections were the other 30 to 40%, but having that partner to lean on was pivotal.
I think that sort of answers my next question. We thinking about for anybody out here listening to the podcast that might be interested in starting a search fund or becoming an independent sponsor and doing a fundless fund, if you will, in terms of critical resources. What would you say, sort of those top 3, top 5 resources that you've got to have to be able to get the deal done from soup to nuts?
You need a lawyer who's going to work for you on retainer. You need a CPA who's willing to work for you on a small retainer as well, from a diligence standpoint. You need an insurance diligence partner. I think with our acquisition, there was a lot of that, to go through. And of course, your equity and lending relationships. I would say always have 3 to 5 banks that you can run a deal by at any given time, and also have good equity relationships who actually write checks, consistently, that you can run deals by and get their perspective.
And how did the relationship with the syndicate come about?
They're part of the search fund ecosystem. So,
Okay.
Met them at a conference, actually. That's how it started, pitched them a deal. That first deal, they said no. Came back with this other deal. They said yes.
Awesome. Well, I appreciate you sharing a bit about your experience, and I think it's super helpful to kind of understand some of the things you need to think about on the front end when you're going to launch a fund and start chasing down these deals. But I wanted to pivot and just talk just a little bit about what it's like to be a Black independent sponsor, or even a Black person working in the private equity and finance space. I'm curious. I want to get your thoughts on what are some things that we could be doing as members of this ecosystem, members of this community to help grow the Black independent sponsor community and drive sort of the industry support that we really need to see more activity in the space.
Definitely. I think it's a lot of what you're doing is critical. So, you personally, your firm, it's the conferences, it's the podcast, it's growing the ecosystem. Again, it goes back to that thing I said, one leads to two, two leads to four. The more visibility that's out there, the better it's going to be. There's also creating on-ramps. So the firms that are, specifically targeting diverse capital, those are extremely important as well.
When we're talking about firms that are specifically targeting diverse capital, are we talking, minority-owned businesses, or are we talking about folks like you that may be, interested in person of business that can potentially serve a minority or underserved community? What's sort of at the, what does that really mean when you drill down?
I think it's both, but more so from a capital provider standpoint, those that have a focus around diverse managers. So that can be New Majority Capital, that can be Stonehenge. There's a multitude of that are focused, on providing capital to minority managers. So.
Gotcha. Yeah. Well, look, man, I appreciate you being on the podcast today. I certainly have enjoyed the conversation and think there are a lot of nuggets there for our listeners. But I always like to close out our episodes by asking a couple round robin questions that help folks in the audience learn a little bit more about you as a professional, but also find some things that are going to help them and enrich themselves as professionals. So just a couple of quick fun questions, man, and we'll get you out of here. What's one book that you recommend that's been transformational for your career?
Reginald F. Lewis's book, as well as the Harvard Business Review. They're How to Buy a Small Business. Those two were transformational for me. When I was 18, 19 years old, I picked those up in college. I had my first seller meeting after reading HBR's book. When I was 19, there was a guy selling 3 juice shops in New York City. So I love to purchase a business. That was the first time I had a seller meeting. So those have been foundational for me. Reginald F. Lewis's book. It's always going to be paramount.
Yeah.
So.
Yeah. Awesome. What's the single best piece of advice you've received from a mentor, personally or professionally?
I would say it came from my dad more so than anything else, which was be detail oriented and be persistent. You can win at anything you're going to do.
All right. Yep. What cocktail best describes you and why?
Yeah, I would say a mezcal old fashioned. It's a classic, but it's smoky.
Awesome. I'm a big mezcal fan myself, man. I can't get into the bourbons with everybody else. I felt like it was a little too trendy, and so the mezcals still give you sort of the natural sweetness of a tequila, but then that smoky flavor. That's right. That still, I think, for guys like you and I mean, it still gives you sort of that I'm sophisticated. I'm still a classic man kind of vibe. So. Awesome, man. Well, look, man, hey, again, appreciate you making time to join us on Accessing the Pipeline. Ladies and gentlemen, Austin Smoak, founder of Grove Oaks Capital. Thank you.
I appreciate it so much. It was fantastic, Rubin.
Thank you for joining us on this episode of Accessing the Pipeline. To learn more about today's discussion, please email host Rubin Pusha III at rpusha@McGuireWoods.com. We look forward to hearing from you. This series was recorded and is being made available by McGuireWoods for informational purposes only. By accessing this series, you acknowledge that McGuireWoods makes no warranty, guarantee, or representation as to the accuracy or sufficiency of the information featured in this installment. The views, information, or opinions expressed are solely those of the individuals involved and do not necessarily reflect those of McGuireWoods. This series should not be used as a substitute for competent legal advice from a licensed professional attorney in your state and should not be construed as an offer to make or consider any investment or course of action.